Welcome to The Buy-In, Commercial. I'm Nick Selby, Director of Commercial and Advisory here at Sevenfold Property Group. For this special series, I'm joined by Luke Bolden, our Head of Acquisitions, to talk all things commercial property. The deals, the opportunities, the risks, the wins, and what's really happening in the market. We don't always see eye to eye, and we definitely don't rate each opportunity the same way. But we do agree that commercial property can be complex when you're not working in it every day like we are. So we're here to make it easier to understand, share what we know, and have a bit of fun along the way.
And I guess commercial property, as we know,
It's probably a good start, isn't it?
it's what we do.
It is what we do. Done it for a little while.
A little bit. But apparently it's really interesting right now.
It is. It is most certainly the flavour of the month. Well, not flavour of the month, but I think there are some very strong tabloids around commercial property at the moment.
There is. And why is that? Is it changed? Is it any more attractive right now than it ever has been? Is that what it is?
I think there's more education around it now, or there's more noise about it than ever has been. And I think that's a combination of a few things, whether it's the changes to the residential network and negative gearing, the abolishment of that. Obviously the emergence of buyer's agents as well. That's been a really heavy trend in our industry in the last 18 months to 2 years. And I think the flock generally goes, or the herd goes to what is the brightest. And I think commercial is very much that at the moment for various reasons.
So what in the past, what has held people back from commercial property? You know, it's always been there. We've been doing it for a long time. And, you know, in our world, the fundamentals haven't really changed in terms of what makes a good commercial property and why that's an investment strategy. So, you know, what has changed? What do we need to be careful about as well with the increased interest in that market?
Absolutely. I think, and I said tabloid before as well, and I think that's very prevalent in what we are seeing. A lot of people are wanting to get out of that residential sector. One, negative gearing's been abolished as well, but if you look at the actual yields that they've been deploying or attached to, they're generally on a gross basis, and they're generally pretty tight as well. So from a residential perspective, you're looking at a 4% gross yield, which gross and yield just don't go hand in hand anyway. The definition of yield is net, but realistically, once you start to pull that back, what are you doing? 1.5%, 2% net? And then once you look at it on a cash flow basis as well, you're in the negative
your costs
position.
of that.
Yeah, absolutely. And then you look at the commercial sector, and obviously region and asset class specific or dependent, you're looking anywhere from 4.5% net to 8% net. So I think there is a lot of attraction there, and that's a bit of the deer in headlights, I'd like to think, perspective from a lot of these residential buyers at the moment.
So maybe let's go back a bit. Why do people traditionally look at commercial property, forgetting where we are today, but what are probably the sophisticated investors or those at a different stage of their investment journey? Why have they turned to commercial property previously? What are the benefits? Like we know it's traditionally you go into it for income, right?
Absolutely.
Generate cash flow.
Yeah.
So there's that. You have longer leases. So generally speaking, the income is more secure.
More secure.
It's longer. Significantly longer. You know, a commercial lease is typically 3, 5, up to 10 years, depending on the asset class, the type of tenant. So you can grow that asset through those leases, but also the capital growth of the property.
And the capital growth piece as well. We want to just talk about the leasing income for a moment there as well. Your rental income is compounding annually too. So if you've got a fixed increase of 4%, or if it's attached to CPI, you know that year on year your rent is actually increasing in line with market as well.
Okay, so someone just wants some passive income from a commercial property. Why is everyone not doing it? What are the barriers? You know, we hear quite often it's either a perception or some of the things are a reality of those barriers to entry or challenges to get into commercial. Often it's just not enough education, but there are some significant differences when you invest in commercial property versus residential.
Absolutely.
So what would you say is the number one sort of perception or fact of getting into commercial? The challenge.
I think conception would be, or misconception would be, that you need millions of dollars to get into commercial. I think when a lot of people do think about commercial property, they think shopping centers, they think 10, 15 million, $100 million office buildings, petrol stations, childcare centers, the likes like that as well. But the reality is you strata titled industrial units, commercial, your strip retail is commercial, your offices are commercial as well. And they're all much lower entry points too.
It's probably a piece around not understanding, or, a lot of people traditionally have been on the journey of generations of investing, buy your own home, pay that down, you get to retire, maybe pick up another couple of residential investments on the way. So that's traditionally the path or the easy nature of investing in property.
That's what we know, isn't it?
Correct.
It's what's been the Aussie dream. You buy the house, you lean on capital growth, pay
equity,
it down like you said as well, and then eventually you're going to own your house outright, and thanks for coming. That's all it is.
So I don't have millions to invest, but also I don't understand the market. I don't understand how leases work. It all seems too complex, right? And maybe, on face value it is, but with a little bit of education and some help, it really isn't.
And I think that's a point that we need to really harp on as well, that there are levels of intricacies and complexities to the commercial market. And it isn't just the tabloid yields that you hear out there, but there are a lot of specialists out there that can help make that process a lot easier.
What if we look at let's talk about a typical client that, generally speaking, a client might have a couple of residential properties, right? They've built some equity through that journey. It's maybe they have a couple more than two, maybe it's 3, 4, 5. At some stage, you pretty much max out your borrowing capacity in residential, and you're looking for something else. And it may be a different time in your journey as an investor as well, at a different age bracket, where you're looking at the back end of your career, or, you're looking to generate some cash for that passive income piece. You've got the equity in residential. You look at commercial to do exactly that. So that would be quite a general, client that we see. That come to us and say, hey, this is what I want to do. I want to generate X amount per year.
They've got equity that they want to deploy that's going to be cash flow positive for them.
And even more so now, the residential piece probably doesn't stack as much as it used to.
No, not in the traditional sense.
So, that's what we'll see. So maybe they come to us with some equity piece, and let's have a look at something on, just broadly speaking, on a $1 million asset. We could go into a lot in this, and we
might have to
be
get the
careful.
beers ready for that.
Yeah, because we could be here forever. But let's just look at a general $1 million industrial asset. Okay, and it's got a lease for
3 years, 5 years.
Okay.
You got a bit of security to the lease there as well. Let's just say we're looking at a strata title tenancy at that price point. Industrial's hot. Industrial has been really driven by the owner-occupier market. So when we correlate that across to a leasing market that is contracted, but there's been a pivot from tenants to owner-occupiers, the available vacancy is light, but there's been nothing to really stimulate it higher either as well. There is a bit of a cap to what that industrial leasing market can do. I'm going somewhere with this, but because a lot of those tenants have pivoted to owner occupiers, they need the space. It's your tradies, it's your Sparkies, it's your e-commerce, it's your quasi showroom, some of those indoor rec guys. They will pay a little bit more to get into a space. because they want to use it for themselves. Across the board, your owner occupiers will typically drive the market up. And because a lot of those owner occupiers were past tenants, they've pulled out of the leasing market and kind of
So what I think you're getting to is what sort of yield we could expect.
Exactly that.
So, and we'll go into low, high, and some of those, what that means and different asset classes and why one's good, one's bad, or they're not. We'll get to that. Let's assume 6% net yield. Okay?
Call it 5.25, 5 3/4.
Are you going to do the numbers on 5 1/4?
I reckon so. I reckon I can do that.
All right,
commercial maths.
Yeah. Okay. So $1 million property at 5 1/4.
Yeah. 5 3/4.
So it's a decent lease in place. There's some demand. There's maybe low supply. So that's why it's call it 5 1/4.
3/4.
5 3/4.
5 3/4.
Okay. 5 3/4. Let's go with that. So what would an investor looking to get into that asset, what would that cost them?
What would that cost them?
Yep.
Look,
let's do it just a general easy, because this is the first question we get asked, right?
Absolutely.
How much do I need? Because apparently I need way more than I think.
Yep.
And it's too hard and I can't do it. And so what does it look like?
Okay, $1 million.
Yep.
And contrary to what you do see in the residential space, where you're coming up with a 10% deposit, it's a 90-10 LVR, loan to value ratio. On a residential property, you only need $100,000 to get into it. In the commercial space, your LVRs are a lot different, but that does benefit you in the long run as well on the cash flow piece, and we will come back to that. But let's say we're on a 70-30 LVR, which means your deposit for that one is $300,000.
Yep.
A lot of people just look at it and go, at the same time too, $300,000 is a lot less than needing millions to get into the market.
Yep.
But
and often they've built that equity through some other asset classes.
They might
that
have some cash in the bank. They've got some equity that they can pull out and redeploy. If you've got a couple of residential properties, it's very, very easy to get your hand on those kind of
or
reserves.
A lot of the sole traders in their super, so an SMSF option.
Absolutely,
also.
Absolutely. So call it $300,000 deposit on $1 million property. What a lot of people do neglect to identify as well is your acquisition costs.
Yep.
You've got stamp duties. You've got your legal costs. You want to ensure that you're doing your due diligence and you're building in pests, you're building inspections appropriately, and you've got some consultants along the way as well.
So what you're getting to as well is often we see in marketing, social media, a return on a commercial property, and just all we see is the headline yield.
Absolutely.
And someone goes, it's $1 million and it's 6%, so I'm getting $60,000 cash in my pocket.
100% the point.
Not correct.
Not correct.
Not correct. It's a real number.
It is. But that's a very simple equation as well. It doesn't demonstrate the whole picture.
Yep. So, sorry.
Yep. So
carry on
that note, look, for this example, 5 3/4, $1 million, $57,500 after your outgoings are paid, and just outgoings, body corporate, council rates, water.
Which the tenant pays. Almost all scenarios.
We've already considered that.
Yep.
Whether it's a gross lease or a net lease structure, we still work on that net basis. Yep. So again, not to get confused with those gross yields that we see in residential, everything is worked on a net basis, but less particulars, not the whole picture. And that's where it does start to get a little bit complex when you start to look at your cash flow position versus your tipping costs versus your headline yield, as you were saying there as well.
Is there could you get to a percentage, on what those traditional or generalization of those acquisition costs could be? Is it 5% of a purchase price? Is it, is it that? What?
I think you probably, and don't quote me on this, anyone, but I think you probably sitting a little bit closer to, let's use this one for example. You got $300,000. It's probably going to cost you about $370,000 in total acquisition costs. So what's that? $70,000 of $1 million, you're at 7%.
Okay.
So we'll use that very loosely. There we go. That's my asterisk. That's the disclaimer.
And so what do those costs include?
Your stamp duty.
Yep.
That's a big one that people often neglect. Building and pest, your legals, if there's any planning, any consultancy fees as well, advisory fees, if you're engaging somebody to acquire it for you. Putting aside a bit of a buffer as well. You always want to ensure that you are not leveraging yourself completely and drying out the bank account.
Yep.
You want to have some cash and reserves too. So we factor all of that in. In a circumstance like that, $300,000 deposit, $70,000 should cover most of your other entry expenses. And then you work on your cash.
So what do you call that? That's cash on cash?
No, that's they're your acquisition costs. So that's the capital required to buy that $1 million property.
Mm-hmm.
That is going to get you 5.75% on the headline yield.
Right. So that's that number. And then what are the other considerations? Say if I'm asking you, I want $1 million property, tell me what my return is at the end of the first year.
Yep.
And often what we see in those figures, headline figures, is just that yield.
Yep.
And like we've already touched on, 57,500. That's not your true net position after all of your costs based on a 70-30
or your cash flow position.
Your cash flow position. So what would that be? Not holding you to it, but acquisition costs included, servicing costs, those type of things. Yep.
And this is one, going to test my public school maths.
Yep.
But two, this is very subjective, and we'll probably unravel to this point at a later time as well. But again, it's very subjective to the LVR that you are coming on board with as well. And like I said earlier too, the larger the deposit, the better your cash flow position is going to be at the end of it. And dependent on the structure of your loan as well. Is it a full doc? Is it a lease-doc loan? Because they're also going to come with two different interest rates, which is ultimately going to impact what that cash-on-cash basis looks like. So just to get to the bottom of that, I'd be saying on a 70-30 LVR on a full doc position, you're probably sitting closer to 2% cash flow. On a lease-doc, you're probably closer to 1.5%, 1.65%.
Yep. Okay.
% positive cash flow year on year.
So full doc, lease doc relies on the security of the lease, and the tenant
puts
correct?
More of an emphasis on the lease, the income that's derived from the lease.
So you can effectively service the financing costs through the income of the lease.
Yes.
Correct?
Correct.
But that's still a higher interest rate, generally speaking.
Correct.
Yep.
Yeah.
Okay.
Whereas your full doc,
you're taking it all on basically as the vendor.
Yep.
Yep.
And they're considering
and
your
your
own circumstances as serviceability as well.
Okay.
Now, a few extra layers to that too, but as a general consensus is lease doc, they'll still obviously consider the borrower's capacity and ability to guarantee it and everything like that as well. But from a serviceability perspective, on a lease doc loan, that income on the property has a lot more weight from a lender's perspective.
Mm-hmm. Okay. So let's go back and just overall look at that $1 million purchase at 5.75.
Mm-hmm.
So taking into account your acquisition costs, your servicing costs, all of those things at the end of year one, what would your general cash on cash return be year one? Is that an easy?
It is. I'm going to need to get a calculator. Is that all right?
Yeah. Just give me a.
I'm going to give you a number.
Yeah. Okay.
It's early. I've only had one coffee.
So I think this is important to understand. Often we're
working on $1 million. 2.3%. What's that? 23,000 give or take on a full doc.
Mate, I was going to say something, but I was just going to let you do it. I was like, I can do that math.
Hey, look,
and
it's
I know
my
you
first
can.
podcast. I'm a little bit nervous here.
So look, I know your spreadsheets are like unbelievable. So that's how you work. Yeah. But okay, so we're $1 million, give or take 15
grand, give or take.
At 70-30.
At 70-30.
Okay. And there's different levers to pull on that, on the leverage on, that financing aspect, but give or take 23,000.
Yep.
So I'm coming into commercial. I want to purchase something. I want to generate income.
Mm-hmm.
Maybe in your first year, it's going to cost you close to 400,000 to get into that 370 that we worked on. And you're going to return 23 in positive cash after every expense.
Yep.
All right. So where the power of commercial comes in is through generally, and we'll get to this, but generally speaking, the lease, right? And that's how you grow. You make the lease work for you, and your income position grows and compounds through the strength of the lease, right?
That's in a very simple way. Yes. You are, the value of the property has a lot of influence by the strength and the income value of that lease.
Mm-hmm.
Quality of the covenant, yields applied to your expiries, different styles of tenants. But yeah, simply put, the more secure the tenant and the more secure that lease, the more secure the end value is on the property.
So annually, say we work off that 3-year lease, you've got conservatively 4% annual increases running through that. So that compounds each year.
It does.
Maybe you've got an option over that. That lease has got an option in it that, resets to market value. Then the increases compound further. That's pretty powerful in that lease, and that cash flow position. Cash flow position improves, compounding each year. But also, what does that do to the capital? This is another misconception, right? That commercial property doesn't grow in capital value itself as opposed to residential, which doesn't make sense. But what happens to that?
Well, it does increase. Absolutely. Let's look at it from a 4% annualized increase on a cash basis, or your cash flow position. Use that 23 grand, for example, an extra 4%, you got an extra grand a year.
Yep.
And then that obviously, that's a lot higher as well when you put it back to that net position before the cash on cash basis. And you apply the same cap rate. You buy it at 5.75%. You do that against the increase of rental. Ultimately, that's going to spit you out a larger number on the end realization value. So this is where I will need my calculator. If you wouldn't mind, I can spit you some quick numbers. Unless you want to try and do it.
No. You're the expert here, mate.
I don't know, mate. I think you bear a little bit more weight in this industry than I do. So if we go 57,500, which we were originally working on, it's a 4% annual increase. That brings your net position, not your cash flow, but your net position up to 59,800. And if we put that against the same 5.75% yield that we bought it at, your capital value is increased by $40,000 just in that succeeding year with that annual increase, just by doing absolutely nothing to the property, depending purely on that annual increase and applying the same cap rate and the same yield, assuming the market doesn't go one way or another.
In 12 months, you're pretty safe.
It's safe as houses.
So is that where that comes from? Yeah, nice. Okay. So that's a 40 grand uplift in year 1. Year 2, sorry.
Yeah, in the following year.
In the following year. So
it could be within 6 months of purchase. It could be within at very latest within 12 months of purchase, because it's all subject to the anniversary of that lease commencement date. And if you're purchasing something with a lease already in play, you could be coming in at any single part of that timeline, but those annual increases are on the anniversary of the commencement date. So in some circumstances, we do look at assets where they're maybe 6 months away from that annualized increase. We're still running the numbers on the current income, but we know that by the time we go through negotiations, go to contract, your settlement period as well, you might only be 2 or 3 months away from that actual increase being applied, which gives you even more accuracy to apply the same yield against it, knowing exactly how much equity you've built in a very short amount of time.
So, and we were probably pretty conservative on that lease length, being 3 years. It's probably pretty average in the, leases, they differ in asset class,
value of the property,
size of the property.
And I think if we're looking at an industrial property in $1 million, it's you're right to presume that we're looking at a strata industrial.
Yeah.
And in that circumstance, I don't think we're seeing much more than 3 year terms.
Yeah. 5 at
Could
most,
get a 5.
probably.
Yeah.
So 3 to
lucky.
5. And, if that $40,000 increase and you're just talking about year 2, you extrapolate that out over
it's going to be more than 40 grand
terms. It's going to compound a little bit more each year. Yeah. So all of a sudden you haven't done much. You've just secured a decent lease.
Yep.
Right. So leases are very important, and it's something that we've been involved in for a number of years.
How many years, Nick?
20.
20 for yourself?
Yeah.
Yeah. Am I 14?
Yeah.
I don't have grey hair. I'm just losing mine.
Yeah, I know. I can't stop mine. So
neither can I.
Like the lease, I think this is the key piece in this market we're at the moment with the flock to commercial that is a potential pitfall for a lot of buyers coming into commercial. You look at the headline numbers, you look at those paper numbers of a yield, and you go, great, I'm going to smash it here. This is awesome. But a lease can be very intricate. It can turn your investment sour pretty quickly.
Very quickly.
If it's not understood. So we could talk about this for weeks, but the key points of, commercial property, it's the cash flow.
It is.
It's the strength of the tenant.
Very much so.
It's the market.
Yes.
Which essentially you're judging risk against. If you lose that tenant, you always will. No matter how good your property is, for whatever reason, the best tenant will always leave.
They will. They're going to upsize. They're going to downsize. They're going to relocate.
They're going to buy
sell the
something
business,
themselves.
They're going to retire.
All of those things. So, it's important to understand the market that you're buying in through your own knowledge, research, but, an advisor do that. And it's important to understand how easy it is to replace that tenant.
Absolutely.
And what the cost of that is going to be, right? Leasing and vacancy information in a commercial world is much harder to get hold of than residential.
Unless you're looking at office where there is a property council, you're very right. It is I'd almost say all of the data that you see from an industrial perspective, from a retail perspective, from a showroom perspective, it's all purely by somebody just walking the streets, walking the pavement.
I think industrial, you can get info greater than 5,000 square meters.
What good is that going to do us in 99% of the industrial markets?
Correct. So it's very hard to get. It's very hard to understand without a lot of work.
Yep.
There's no recorded data on the strata warehouses unless you're talking to an agent, property managers on the ground, other tenants, other people in your network. It's pretty hard to understand. So unless you can understand that, you really need to do a lot of DD on each acquisition in that market.
Absolutely. And that's one of the elements of risk with commercial property that a lot of people do not put enough emphasis on. And again, going back to those headline yields, great, you've got a tenant for 18 months, but you're buying an office in the CBD where there's still a hangover from COVID and they're sitting at...
And a decentralisation. And
exactly, all the fringe business and everyone's preferring to go XYZ, but you're still sitting in a complete oversaturation of the market.
So, okay, that might lead us into a good point. The difference between, a lot of people coming over to commercial are saying, or a lot of advisors or buyers agents will say, hey, we'll just get you 7%.
But at what cost?
Better. So the difference between a 5% and a 7% yielding property is essentially risk, right?
That's, to put it down to one word, yes.
Yep.
Risk.
So as an example, just to play one out, if you looked at a 7% returning property, it's probably in a regional market.
Yep.
And the reason why that return is greater is that maybe there's less demand, there's more supply, it's harder to replace that specific tenant. So, if you looked at something like that, more often than not, probably almost certainly, lower yielding properties over a period of time, say 10 years, a lower yielding property will outperform that higher initial yielding.
Exactly that. It will still garner you better results.
Yep. So you got a 7% yielding property, on paper looks great, but it's regional. What probably happens, and exceptions to rules, of course, but you look at it over a 10-year period, that 7%, you might lose that. Say you lose the tenant at year 4.
Yep.
It's a tougher market with higher vacancy. It takes you 6 to 9 months to replace the tenant.
So what are you seeing in the office market at the moment?
Yeah. Well, depends on the size and the area, but absolutely, it's tough. So assume 6 to 9 months. Let's just use some broad numbers. 6 to 9 months of vacancy.
Yep.
Okay?
Which is income lost.
Yep.
And holding costs as well. So
and if you're being smart though, you can cover those with the buffer of, your positively geared property, so you can cover that. But it costs you 6 to 9 months of vacancy. The marketing costs, you probably go to a local agent, someone to put that on the market, seek a new tenant. you've probably got
What
all of the normal platforms to
what are you looking at
advertise,
from a commission basis?
depending on the asset, but probably call it 15% of the first year's rent. So you go 15%, you're all total up, you're probably 12 months, loss of income, right?
So what's the equation? 1 month equates to about 8.3% or something like that.
So let's just round your 12 months without a tenant or the cost of.
Yep.
In a market
that's not
like
considering
that,
incentives either.
well, that's what I was just going to say.
Sorry, I'm excited.
No, in a market like that, you are probably going to have to incentivize a tenant.
Correct.
Whether that be fit out contribution, whether it be some rent free to assist with, getting them into the property and them setting up, whether it be some reduction in the rent because you're trying to, another whole conversation, but you're trying to keep a headline rent so it doesn't affect your ultimate
Well, that's
value.
it. You want to keep the face rent up, but what is that going to cost you? Like, let's use office as a continued example. What kind of incentive ranges are you seeing in the office leasing market at the moment, and how do we equate that?
Yeah. Again, geez, we could call it 10 to 20% in pretty good markets.
And is that on the first year, or is that on how is that calculated?
It's on the lease value.
Yeah.
So say you've got a 5-year lease, it's on that.
So $100,000 a year, you've got $100,000 net.
Yep.
5-year term, you're at $500,000 in net income.
Mate, some markets are more than that. Some markets are 30% of the lease value.
Which is, and going back to your point earlier as well, that's where it is so important to get an advisor on board that understands the mechanics and the intricacies of the leasing market, because that's what you're buying. Yes, you are buying the bricks and mortar, and there are other values that underpin those yields and those lease rates.
Yep.
But the value of your property is directly or pretty closely correlated to the value of your lease.
Yep.
And if you are chasing that high yielding asset without considering those risks, like to your point earlier, a tighter yield is going to outperform a high yield over 10 years because of these costs that you're raising.
So 10-year period, you might have vacancy for 2 years effectively that you have to carry, or costs of 2 years of that 10.
Yep.
I would say that's probably conservative, because you may only get a new 3-year lease and then you might have to do it again.
And what does your CAPEX look like through that?
Yeah. So you've got costs associated with a whole lot of stuff where, okay, and looking at the 5% yielding property, initially you're like, oh, it's pretty tight and it was competitive and I probably paid a little bit more than I wanted. But you've got a 5 plus 5 year lease. You've probably got a really strong tenant. You've got probably 4 or 5% increases built into that. That travels along really nicely, and you can sleep at night without,
And let's agreed. And then maybe let's look at something that is close to that 5.5 or 6% as well. Even if the tenant were to leave, you're probably still sitting in a very undersupplied market. So if you were to lose your tenant, you're not looking at that 6 to 12 months. You're looking at 1 to 3.
Yep.
When considering all those other facets we were, but also driven by a tighter leasing market comes tighter or lesser incentives to have to put on the table too. So everything compounds in a more positive note. Lower risk, lower exposure, less time on market, less cost to get a replacement tenant in. I think your industrial agents are typically going to charge a little bit less than an office leasing agent or something to that effect as well. So
the market's tighter.
Everything gets all of the above.
Yeah. So it is important, and we don't just buy something. The reason why you would look at something that is a higher yield, there's a couple of reasons. Maybe there's some value add that we've identified. Maybe the lease is, coming to an end. It's shorter, but there's an uptick in the market coming.
Yeah.
Maybe we know something through our own research or networks that there's infrastructure coming in that area, or there's certain industry coming in that area, or something's being built. I saw an example the other day of an office purchase. There was a Bunnings just being built next door. The rents went up 20%. So unless you have some really specific knowledge in those higher yielding opportunities, I'd tend away from them unless you've got that really good knowledge.
And where do you get that really good knowledge from?
Just time in the market and a lot of DD and a lot of questions and a lot of work and hours into those.
I think a prudent point there as well is all of that comes from being on the other side of the fence.
Yeah.
You know, where we are on the acquisition side now, the advisory side, or all of the above. We're buyers agents. But we come with in excess of 30, 35 years of being on the brokerage, on the transaction side.
Yep.
We understand the levers. We understand the layers, the intricacies, the mechanics, what influences what. We've seen the cycles. We've been there. We've done that. We know where the value adds are in the property because of it's all the advice that we're giving to our landlords when we were leasing properties, when we were selling properties.
Yep. And sometimes it's not as easy as discovered multiple times. You look at a selling, a purchasing opportunity, and you look at it and there's long leases on it. They're new leases. So you're thinking, great, we've got security of income. This looks amazing. The rent's pretty good. Everything's wrapped up in a nice little bow.
Mm-hmm.
And while that might be a good opportunity sometimes when, you're looking for a client for that exact reason, sometimes going a little bit deeper into that, can show you some reasons why. Often things are positioned to sell. And when they are, they probably squeezed everything out of it.
Yep.
And you as a buyer, the only option of that growth is time because it's probably maxed out for the next
it's
few years.
Realize all of its potential.
And there's probably a lot of competition for that because people are just looking at security of income and, so you're probably going to pay, generally speaking, you're going to overpay for that.
Yeah. And I think maybe just strip it back a little bit there as well. You made a point of it's been prepared to sell.
Yeah.
And what is something that we see a lot when people are structuring the leases to get the asset ready to go to the market?
Yeah. Well, it's the rent is at the very top or maybe a little more than.
It's inflated.
It's inflated. That's a nice. Okay, I was being nice,
no,
but no. So
there's a lot of people telling porkies out there in the market.
Yeah.
And they are hoping for those investors that are just going to come across and look at it from a tabloid perspective or the headline perspective. It's netting me $100,000 a year.
Mm-hmm.
I'm going to get 6% for it. Thanks for coming. That's better than what I was getting residentially.
Yep.
But in reality, and back to some of those points you were saying earlier as well, what is the likelihood of replacing that tenant if they were to leave? And one of the big things that we look at when we are assessing a deal is, well, the first thing I look at is that lease in line with market? Or is it inflated? Because if it's inflated, we know very well that a lender and a valuer are going to pull that back to an adopted rate.
And conservatively as well.
Very conservatively. And look, you can have a 5-year lease in play as well, but there's nothing to say that tenants don't liquidate. They do. There's nothing to say that they don't go bankrupt. They do. There's nothing to say that they walk away after a day of trade and you never hear from them again. They do. Which is another vulnerability to commercial. The same thing happens in residential, but obviously that's backed by a tighter residential pool or a tenant pool. Whereas with us, if somebody was paying you, and let's use an office for an example, $650 a square meter net, which in our market we know is pretty ambitious.
Yep.
And we've assessed it knowing that you're only probably going to get $450 a square meter net.
Yeah.
You are clutching at straws, trying to leverage the asset back to the position that you bought it at when it was never available in the market to begin with.
Mm-hmm. What if we talk about the example that we ran the rule over recently and it looked like a nice little acquisition.
Yeah, certainly.
So this one was it was a standalone freehold building, office building.
Yep.
It had 4 separate tenants. Brand new leases. What was the total? It was just over 1,000 square meters. On face value, this looked pretty good. There were a few things we looked at though with a bit deeper DD that we just thought, for these multiple reasons, not really comfortable looking at it. So to start with, we looked at the leases, 4 separate leases, all struck within the last 2 to 3 months. One actually hadn't even commenced yet. It was commencing in the next couple of weeks, so it was already there. When we looked at that one, just purely on the rents and the market, that one was $30 over, $35, I think, dollars a meter over the other 3 leases in the building.
Yep.
And we thought,
and how big was that space?
that was 200 square meters.
So you're already $6,000 ahead.
So we thought, what? Okay, well, these other ones are under rented. Well, they weren't. They were at market.
3 versus 4.
Yeah. So the fourth one was above market.
Yeah.
Then we had a look at the history of it was a relatively new building. It was 5 years old.
Mm-hmm.
Looked at the history of it, and it turned out it was constructed by the owner as an owner-occupier originally as one single tenancy.
Which that creates a whole another recipe of services, and we can get into that at a later
And then it just happened with some more digging that new lease was a related party to the current ownership structure.
So there's the inflation.
So that immediately told us maybe they're positioning this to sell. They've, leased back to themselves on a new, it was inflated. It is to market, not by a huge amount. So you could probably justify things, it was a ground, all of those things. But that was the first sort of orange flag, let's say.
Yeah. Yeah. Let's have a look at this a little bit further.
Yeah.
And that $6,000 a year in income that if you were to re-adopt market value, you lose that on your leverage.
Yep. And then we looked at the building history again and a couple of calls to people in the know who may have managed it previously, et cetera. And we discovered some potential issues or previous issues, I'd say. I don't want to, talk too down to this, but there were some water ingress issues with the building.
And in a 5-year-old building as well.
Yeah.
Ugh.
So, but that was not in the Form 2 or the disclosure statement. So whether, that was rectified, obviously. So there was no immediate issue with that. But again, we thought if there has been in the past, maybe there will be in the future.
Roofs as well. Water will always find a way in.
Expensive.
Yes.
Right. So second orange flag could be fixed, whatever. There weren't any existing problems, but it turned out 2 tenants had previously been let out of their leases when they had those issues. And so they'd been replaced. So fair play. They'd been replaced. The issue had been fixed. Then we had a look at the actual property, and when it was split, it meant one of the tenancies, if you were to lose one of those tenants, the access was challenging.
Mm-hmm.
It wasn't as easy because it was one occupier to start with. So, there was a bit of movement to make it work for 4 tenants. It's in a great area, growth. Then, this is the depth of what you need to go into, right? On face value, again, it looked amazing. Everything looked solid. But then you look at the type of tenants, and in that area, they were typically government program funded, allied health, NDIS type of tenants. And typically those contracts are how long?
No, 3. It's actually less than 3 years, isn't it? Because they got to work in the funding systems.
And they were almost entirely the types of tenants in that whole location.
Which a lot of people will look at them and go, hey, look, it's NDIS, it's great, it's government backed, or they're getting the support from the government. And they provide a good service to the community. So on face value, they look like a great tenant, and they typically are.
And if you lose one, typically if you lose the one who's in that exact funding program, you probably replace them with the new organisation that's won that tender.
Exactly that.
So you could say,
so they're very,
there's going to be demand,
Yep.
but the continual cycle of those tenants is going to be a management issue.
Oh.
It's going to be relatively costly every 3 years or less. So, I think that'll be a good purchase for someone, right? But we looked at it and just went, there's a few things that don't pass out full test.
And there was a point that you mentioned before as well. If a tenant were to leave, and let's just say NDIS gets eradicated or there's some major reforms through it, and you're not going to get that type of tenant again, you've got to look at what points. Okay, what kind of tenant would take up this tenancy, and realistically, what's the leasability of this tenancy? And you mentioned some configuration issues. You look at developers that sell high rises; they always sell the low floor ones with views that are eventually going to get hindered before they sell more prestigious ones, because you don't want to be left with the stale stock. And from a tenant perspective, functionality, accessibility, natural light, configuration of the fit out, they're all prudent points too. So you preempted the leasability on the other side. If we lost a tenant, you're probably going to be stuck with a vacancy.
Well, you know what the other issue was? All of those leases were struck on the same terms at the same time. So when do they expire?
All together.
All at the same time.
So
So that would be a massive tip as well when we're looking at something that's multi-tenanted. Yeah, in all efforts, make sure they're staggered.
yeah. And
Right.
a point there, maybe you look at whale and you might just go, oh, look, there's a 3-year whale.
Yeah.
But when they're all exiting at the same time, the risk is you go from 100%
Risk is
occupancy to 0.
Right. Look, there's a time and a place to align leases if you've got future plans for whatever, or you've got another tenant that looks like, has made, their voice about they want to expand.
Mm-hmm.
So there's some exceptions to that rule, but you don't want to be lumped with that risk of all your tenants leaving at the same time and having to replace the same tenants with the same tenants. And yeah, that'll put you in a big hole.
And that's, I'm probably going to divest a little bit here as well, but you just raised a good point. When it comes to tenants, and this comes back to being
divest?
in the know.
Is that what you just said? Digress?
Digress. Yeah, sorry.
Whatever.
I went to public school. Being in the know, like in a circumstance like that, say you were to lose one tenant, but you knew that the adjoining tenancy, they were looking to expand, there might be an opportunity for them to occupy that upcoming vacancy, increase their footprint.
Yep.
And then you minimize your risk of having to go back out to market to find a replacement tenant, right? You know those things by being in the know, but when it comes to an asset, that's through asset management. And let's maybe look at a building that you've been looking after for in excess of 10 years. It's an A-grade office building here on the Gold Coast. You've struck most of those leasing transactions in there, and anyone that's moved through the building, whether it's expanding or compressing, you've probably repositioned them within the building. We're located in the building, so you see everybody all day, every day. The value of managing that asset, knowing your tenants, and being able to have those be in the front, knowing what their intentions are as well, allows you to mitigate those opportunities internally as well. Because we see it so often as well that somebody will hold an asset, they'll have a different leasing agent to what they have, a selling agent to what they have, a managing agent. And through those channels, which are all such important components of ensuring the security and the success of your asset, if they're not communicating with each other when they're opposing brands, they're competing agencies, they're not going to divulge all the information that they know, you are going to create channels of disconnect through the communication, which ultimately impacts your success or your ability to mitigate the risks of losing a tenant. Hey, this tenant, he can't afford 200 square meters anymore, but he's still got a requirement for 100, 150. Instead of losing him altogether, let's relocate him to a smaller premise. And that premise that he is probably going to be fairly leasable.
I think, just as a little bit of an aside, I think that's a really good point about the relationship between, in commercial property, the relationship between you, the owner, and the tenant. It's a business relationship.
It is.
Right? So there's benefits to that as opposed to residential, right? I don't talk bad about that either, but
it's differences.
There's differences.
There's differences.
It's a business relationship. Your tenant is running their business and their brand from that premises. There's generally a lot more care that's taken to that premises.
Yeah, client facing.
You can have business discussions around your negotiations.
No emotions.
There's far less.
But there's less.
There's far less, right? Because it can be demonstrated by market data, information, those conversations. And like you just touched on, in most instances, you're trying to work with, it's a working relationship. So yes, if you've got, in that example you gave, if you can keep your tenants happy and move them around, your downtime's less, your cost is less. Generally, they're in the building for a reason, and they want to stay there. And things change and they leave, but in those larger buildings, it's a massive benefit to have space because something is always changing. So you can help them and you can adjust and you can keep them. So it is a good point, I think, and about that business relationship nature. So
and having a competent advisor on your side as well that not just hears a dialogue but understands the dialogue.
So generally in this commercial sphere of buyer's agency, typically a client comes to that buyer's agent and says, I've got this much. This is what I want to do. Go and find it for me.
Yep.
Right? What we do is a little bit more in depth than that. I think if you're just purely doing that, it's really a transactional basis, and it's not what we've liked for a long time.
And I think it's an isolated transactional basis.
It is, and it probably doesn't get the best outcome for that client, and certainly not on the long term. So I think, what our business does really well is try and understand a client's goals to start with, and then, which we ask the question about what are you trying to achieve, how long you're trying to achieve it in, or what's that time period you're trying to get to your end goals,
yep.
and what capacity do you have, right? So once we can establish that, then we can sort of go to work with what that looks like, involve some of our other team
yep.
in terms of the planning,
yep.
Talking to the accounting piece, and making sure everyone's got their structures in order, that they understand where they sit, what the capacity is. And then we come in and talk about the market and set some expectations, some education, some research, and then go about trying to acquire that
exactly that
piece
and
of property.
I think the best way to look at it in how we navigate it is the property is the vehicle, or one of the vehicles on the freeway that's going to help them achieve their end goals or their ultimate goals relevant to their strategy. And I think a good example of that was just a client that we're speaking to the other day that had come through our financial advisory department, and their particular goals were they had kids that are going to a private school.
Yep.
They need to stimulate or generate a particular amount of cash flow. So they were looking at a commercial investment purely on a passive income basis,
yep.
with a particular capacity and a particular budget.
And where did that capacity come from? Equity, right?
Equity.
In residential.
Yep.
So again, pretty typical. But their goal and their time frame was pretty clear.
Yep.
And their capacity we knew.
Yep.
So it was an education piece to start with, and saying this is what it would typically look like. And these are the types of things that we'd be suggesting in this price range. So that gives us really good grounding to what it is. But further to that, which is as important, is we can tick that box of buying something that returns that day one, right?
We can.
Done.
But settlement,
that's easy.
You buy a property, that's a part of the process, and getting the right property, part of the process, and a very important part of the process. But when you look at it at the full timeline of a strategy, settlement day is day one of that strategy. And it's ensuring that asset, we obviously will we'll analyze the deal intensively before it even gets to a point, and we can go on that later on.
Your spreadsheets.
I love my spreadsheets. They're my trains.
Yeah.
Once we do purchase that property, that's day one of income. That's day one of potential capital growth. That's day one of getting it to a point where it is actually stimulating that journey for the overall strategy and end goal, which is where a good leasing division and a good asset management capacity comes into play as well.
Asset manager, yep.
I like asset manager.
Yeah, so do I, but just,
property manager.
Dominant.
Yeah. And it's ensuring that through that whole part of the journey that the asset is actually performing in the way that it should be for you. You've always going to have upcoming vacancies, whether it's 18 months, whether it's 5 years, whatever it may be, or you've got tenants at the moment. You're walking through one at the moment. The tenant's still got 2 years to run in the lease, and it's a rather large asset, but they want out.
Yeah.
So how do we mitigate that appropriately to ensure that the asset is still performing in the same light as when we purchased it?
Yep.
Or better.
So it really is a upfront strategy, making sure those goals can be achieved, and if not, adjusting them based on some more education and some market data, and then making sure we can acquire that property that ticks those boxes, and then making sure it can be managed throughout the process and the life cycle of that asset.
Yep.
It is pretty powerful when you put it all together, because if you are just doing that transactional piece and just acquiring the property and then going, here you go, good luck.
And how many times have you seen that come undone?
Correct.
I'm confident the way that capital is being deployed across the commercial from that residential piece, with a lot of people not understanding the market to what the market commands. And a lot of the other buyers agents out there at the moment don't necessarily have the experience either. They are jumping ship from resi to commercial because it's hot, it's sexy, it is what it is, and that's fine. But understand what it is that you're getting yourself into too. And time again, we see an asset being purchased, call it a small little neighborhood center with 6 tenants in there. 2 are on periodic month by month. There's a short run to expiry. They're still buying it on that headline yield, going, oh, this is great. But then all of a sudden, 30 or 40% of the tenants have exited and they've lost their income, and the buyer's agent's just gone, good luck.
Yep.
I
got paid.
I got paid. We're here for that transaction. I helped you buy an asset.
Yep.
Cool. Great.
Yep. So if you can combine all of that and package that up with the leasing strategy as well, if something does go wrong, and someone that's in that market and the asset management of that to make sure the whole thing is wrapped up and you looked after through that cycle of that asset, that's pretty powerful. And you're gonna get the best out of your asset.
And that's the principle there, isn't it? It is ensuring that it's not only performing on the day that we buy it, but the continued performance of the asset is there as well.
Well, what does that give you? That gives you more capacity to go and do it again.
Next one, absolutely. Right. Hey, is there rental reversion? We think this one's under-rented.
Yep.
They're coming up. They've got an option coming up in XYZ. Let us start having the conversation now and see how much more we can get out of them.
And that's the thing. Like sometimes the short lease isn't a problem.
No.
Like we've identified that. You can look at all of those risks. You can look at it and go, there's good demand in this area. Or from maybe it's a little hairdresser in that center that you're buying that is looking to exit for whatever reason. You're going to replace that tenant.
Yep.
Right. And there might be an uptick in that rent, or we've identified that there certainly is. So that grows immediately. So short leases aren't always an issue.
No.
Or vacancies aren't always an issue.
Correct. But we will curate those relevant relative to the clients' expectations and journey too. But you're very right. There's value add opportunities in so many aspects, and we can unpack those obviously in due course. But rental reversion, if some of those leases are under rented, I know we were talking earlier about inflated rentals, but the same can be said for under rented tenancies.
Yeah.
If something is 25% below market and we know that there's a vacancy coming up for 6 and 12 months, and there is an opportunity for us to increase that, we'll buy it 6.5%. But if we adopt a market value to that, we could get that to work at 7.5%, 8%
immediately
if we're prepared to get our hands dirty.
Yeah, correct.
And that, like, it doesn't mean that that's you click your fingers and thanks for coming. There you go. There's your uptick. It's about we make it seamless because we see it, we hear it, we breathe it. We have done for 30 plus years, but we know which levers to pull when, but also understand the risks that come with them. That's
the point, right? That the perception also is that there's greater risk in commercial. Yeah. If you look at it just simply like that,
there's risk in everything you do.
Yeah. But understanding those risks and mitigating those risks can outperform something that there isn't any risks. So,
exactly. Identifying them and building a strategy to minimize the burn when you get to that point.
Part of that initial strategy that we hold in the group is risk profile.
Yep.
So it spits out exactly where a client's at and where their appetite is, and based on their existing investment journey and their strategy. So understanding that, we can tailor what those conversations are, what the negotiations are, what the acquisitions look like.
Yep.
And that can adjust, according to time. So it's a really, I love it. I love being able to do this on that side of the fence and take someone through something that's not just that pure one transactional relationship and really looking out for, mate, it's just far more rewarding, right?
It is. And it is the life cycle of the client, and being involved in at least one component of that process and knowing that it's helping.
It sounds warm and fuzzy and la-di-da, but it really is after so many years on the other side of things, and
which is very transactional.
Yeah. It is. It's really great when you can take someone through that process and it can continue to perform,
Mhm.
and you see that client do those things.
So Nick, somebody coming to us today going, what do I need to spend to get into commercial property? And I think going back to what we were talking about earlier, going, you don't need millions to get into it, but the more you spend, typically you're going to get a stronger asset, right?
Yeah, well, that's based on, generally speaking, the smaller the size of the asset, the lower the price point, you're probably going to have a shorter term lease. It's a smaller tenant who has, it might be a startup, it might be a sole trader who's growing, those sort of things. So your turnover might be more often. So those costs and just the general headaches may be greater.
Yep.
By contrast to that, or caveat, there's going to be more demand for those type of products. So you probably see a little bit more capital growth in those smaller, say 200 square meter industrial units, because there's more tenants for them. Right?
And the owner-occupier market as well, right?
Correct. So, but because of the demand, your cap rate's probably going to be a bit tighter. So you're probably not going to get a lot of movement in your first foray into commercial property if your budget is 500 to 900,000, right? Give or take exceptions, and there's certainly spaces for that, of course.
We might be able to go out to Emerald and get something for 800K that's doing you 11%.
Correct.
But you lose the tenant.
Yeah. So I don't want to put an absolute price point on it, but you certainly get the benefit of commercial property if you can scale it a bit higher.
Absolutely.
So I'd say, you probably want to be in that 1+ range. If that's your first entry or capacity, the further you can go to that and the further you can, certainly 2 mil plus would get you into a position where you're starting to get some really significant cash flow.
And what are you looking at there as well? It could be the difference between a strata title tenancy and a freehold.
Yeah, correct.
You could get multi-tenancies in a larger asset where your income's a little bit more diversified. The risk is spread.
And there's probably a nice little price point there in the 2 to probably 5 mil that you're not competing with some larger investors or syndicates.
Absolutely.
And then further to that, the REITs and the major funds and things. So there's probably a nice little gap or price point there where you're between 2 to 5 mil if you can, position yourself in that area. So, and then like you say, they turn into freehold properties, they turn into longer leases, the 5 to 10 year leases, depending on the industry and the asset. So all of a sudden that's starts really generating some cash for you.
And then when you've got the freehold too, value add opportunities.
Yep.
You've got the ability to stimulate more income out of the asset that isn't just on the internal premise, not just on the NLA or the net lettable area.
Yeah.
Right. I guess from my perspective though, look, where like industrial is a no-brainer, but at the same time you're paying for it. You are paying for the security, but you're paying to get in and you're paying to compete because everybody's spruiking industrial. Medical, you get in really strong covenants for longer term tenancies. They're very specialized
High
as
yields.
well. They are specialized, which means if you were to lose a tenant, you're probably going to pick up another tenant, like an ortho could be replaced by a neuro or something to that effect. And they are very, for lack of a better word, incestuous, or they stay within the same pool. Right?
You said.
And they all concentrate in the same area. Referral networks rather huge. So you've got some security there, but again, you're paying for it. Where I'm seeing a lot of value, and it's probably a bit biased given our background predominantly in office leasing.
We could probably debate this, I reckon.
Yeah.
I robustly, not right or wrong, but go.
Strata office fringe city, not CBDs, not capital CBDs, your metro markets, I think is still got, it needs to balance itself out a little bit, but I think it is undervalued and I think it's got a little bit to give in the coming years.
I think it's such a topical conversation, I guess, around work from home, the hangover from COVID, what that's done to office space, all of those things. And I think what you're referring to in those metro market, or suburban markets are strong because of people just wanting to live work a little bit closer to home. That transit piece it grated on people for a long time, spending 2 hours in their day to get to and from work? Can they be a bit closer to home? There is a massive push from landlords in each of the markets across Australia to, deliver high quality office space with the idea that it's a flight to quality for tenants, because it's harder for businesses to attract their staff to the office, to retain them, to attract them. So where possible, that premium and A grade office space is. Well, there's some markets in Australia, and we can get into this in depth another time, but some are performing really well and bouncing back. Brisbane market's pretty strong, right? As opposed to a couple others. But it is, if you can deliver a high quality product, then people are leasing it. Yep. Businesses are leasing it, but not in as much occupancy as they once were.
And I think that's a good point as well. And we are seeing that in a lot of the tabloids, AFR, even Gold Coast Bullies going, the Gold Coast office market is doing incredibly well. I think we need to remember where we came from. And you mentioned the COVID hangover, where vacancy rates in the CBD were nudging 40%?
Yeah.
Whereas now they are contracting at a rapid rate, but Brisbane CBD, you're still looking at what? It's somewhere in the teens in a vacancy, which is low teens, but still a dramatic oversupply.
Yep.
And the cost to attract those tenants is high.
Well, yeah, and the pipeline is really limited because of construction costs, labour costs, etc. So to stack new buildings is incredibly difficult.
Yep.
So the face rents need to, again, another full conversation in terms of how face rents are structured for valuations and what the incentives need to be to reflect all of those things. So that's quite complex in a way, and inflated, and sometimes smoke and mirrors and all those sort of things. But the office market, like you were alluding to, the suburban, the smaller, the decent quality spaces, I agree, are still undervalued.
Yeah, SME market. And it's, again, what we were talking about earlier is understanding the leasability and the tenant demand.
Yep.
And as there has been a pivot away from the transit in the cities, a lot of people through COVID as well that did have those corporate roles that were made redundant have gone out, your accountants, your financial advisors, agents, lawyers, whatever it may be, legal counsel. There's been a huge emergence of SMEs and new started businesses post-COVID, of which a lot of them do require office, not large office, 100 meters, 80 meters, 200 square meters, which is available in that strata tilted market and typically the outer or the neighborhood centers.
Mate, what we've seen lately in the office market, and I think the challenge is, what's evident is businesses don't need to move or adjust as quickly as they used to with addition of staff and growth. They simply don't need to. Whereas, back prior to COVID, if you had 5 new starters, you needed 100 more square meters. Immediately. Right? Or you had to take an extra space or sublease something, or that was how quick you actually needed that space. Now with the work from home, the flexible working, you've got people that are 2 days in, 3 days in. You can manage plus or minus 10% of your workforce without adjusting your accommodation.
Absolutely.
So we're seeing an awful lot of renewals, and it's very hard to move tenants from one asset to another for a landlord to attract them there, because the relocation costs, the fit out costs are mostly above what the incentive level would be to get them there. So it just doesn't stack. So in a way, I think tenants are probably stickier now though, because they're happy in their space. They can manage their workforce numbers in the existing space. Exceptions, of course, but we are seeing it incredibly difficult to relocate tenants at the moment in our market, which is the Gold Coast, and it's a very low. It's 2% A grade vacancy.
Yes,
with only very small pipeline of supply coming. But those suburban markets, like you say, the strata, you can't tell me a 4.5 to 5,000 square meter value on an office space doesn't stack when you're buying industrial at 7,000 to 8,000, which are for concrete slabs.
And you get in $100, $150 a square meter less on your lease rate as well.
That doesn't make sense to me. So there's got to be some. We've seen an incredible increase in base rents on the Gold Coast and office space, but for those other undervalued office spaces, I think there's still growth in almost all areas. Yep.
I agree. I'd like to agree because that was my point.
Yeah, well, that's a good point. Sorry, I think I took that from you, but
Yeah.
But I mean, time will tell, and we've seen how quickly that environment changed.
Yeah, and
so anything could happen.
Agreed, absolutely, and at the click of the fingers. But I think if anything, COVID has taught us to be a lot more resilient. The ones that have made it through are the ones that do have resilience, and there's the connectivity. Rightly, as you pointed out as well, we don't need 3 offices around the country. You don't need to go to Pitt Street to go and meet with your executive anymore.
Sorry to any Pitt Street owners.
Sorry, guys. Collins Street as well, Melbourne. Wow. Everything, like we are so heavily connected through Teams, through Google Meets, through Zoom, through whatever it may be. The ability to work remotely on the hop is so readily available. But at the same time, there is, from a culture perspective, and this sounds very cliche, but the value of having your guys in the office with flexibility is so important.
Absolutely.
People want to be a part of something. And I think even us in our roles, our ability to get off the phone when we're talking to somebody and you've had a conversation with somebody else and just you turn, or what do you think about this? Your ability to learn and understand and hear others around you and apply some of that to your day in, day out and your skill set. You don't get that when you work from home.
No.
And again, exceptions to the rule. There
are very few people that I've met or know that can work properly 100% from home.
Mate, I'm putting the washing on. I'm checking the surf. I'm looking at my motorbike.
You have to be very special to do that. And there are definitely those people that in every organization, and it depends across each industry as well, completely, whether work from home's even feasible.
Yep.
It certainly is, and it helps. But you know what the funny thing is, what we saw as well is the thought process of businesses was that if everyone's flexible, we're going to increase our car park usage. So, we're going to be able to offer more people car parks because not everyone will be in the office at the same time. Where in actual fact, everyone wants Monday and Friday off, work from home. So you've got the same number of people, the exact same number of people in your office every day. So you need the same number of seats that you previously had. And then you got no one in the office on those other days. And so it's a weird, I don't know where it's going, but I certainly like being in the office.
I think the point of what we're trying to say is there is still a demand.
Good. Let's make a point.
There is still demand for office.
Yeah.
And there is going to continue to be demand for office. However, that conversation has changed. And it has shifted away from having the big 1,000 square meter floor plate to maybe being a little bit more condensed, like you said, because they don't need
and a better premise, better accommodation.
Yeah, or even like that B grade stuff. Like we look at some strata opportunities that do have a surplus of car parking that probably was previously an owner occupier and hasn't been redecorated in years, and we can really unravel the flight to quality. And with the strata unit, it's LED lights, a repaint, and a recarpet, and you've pretty much got a new product.
It's not a Pilates studio and inter-trip facilities and
the car parking piece as well. For a lot of years, people weren't licensing car parks, whereas now, back to your point, car parks are very valuable. So there's another income stream through there too. But I think like we can divest heavily into that. But I think for the moment, office is one to look at, but look at with an understanding of what's required.
Yep. Well, let's in another chat, we'll go through some of the other asset classes and have a look at those.
Agreed.
It's not a one size fits all, but it's certainly things that we need to cover off and talk about in each of those. And and we look at it. It's very locational and asset based, but we don't rule out any acquisitions. We just need to do the right DD, right?
Absolutely.